Hey there, welcome back. Joe DeSanto here. Okay, going to answer some questions about young investors, I guess, or people just starting out with investing and, don't have a ton of money to get started with, and then some questions about, tips and tricks for beginners and platforms and so on. But before I get to all that, if you like my content, I would really appreciate it if you could do like and or subscribe. That really helps me out. And then beyond that, I wanted to bring to your attention that recently updated yet again my main course. It used to be called the Financial Independence Roadmap, changing the name to Personal Finance Mastery. It has even more content than my last update in November, but also I've kind of oriented the course to answer the call of about running the business of you. To me, that's really the best way to encapsulate what personal finance is. And it's more than just budgeting, it's more than just saving. It's kind of a holistic approach to being the most optimal you can be with your finances, making good decisions going forward, and being informed about the things you need to know in the future when that time comes. So I try to make it as easy to follow and give you the most top to bottom comprehensive approach to personal finance. If that sounds good to you, check out the link below. Thanks so much. Okay, so on to these questions here. I would say the number one piece of advice for someone starting out with investing is to get started. And you can get started small these days. You can honestly probably invest as little as $10 a month. I don't know that that is a worthwhile endeavor. That's a pretty small amount of money. But I would say people should at least embark on saving $100 a month regardless of your income. Like, you have to start to put some money away and get in that exercise. Investing $100 a month for the next 30 years is not going to get you to quote unquote the promised land, as I like to say, but it's going to get you in the mode of investing and it's going to get you started. And if you have to figure out how to reduce expenses in some other category in your life so you can accommodate that $100 investment, do that. Now, long term, you're going to need to invest more. And often people talk about you investing a certain percentage of your income, and I understand why that is. But the truth is, it's not about a percentage of your income. You should have a financial total goal, growth goal, and you should invest the amount it takes to get there. Now, I want to say, regardless of your income, I know I say that lightly because I know if you're not making that much money, you can only save so much. But your goal in the shorter term should try to be to get up to at least $1,000 a month of investing. And then depending on what your ultimate goal is, you may even need to do more than that. Maybe in your 30s and 40s when you're making more money, you're saving $2,000 a month. I'm going to do another video where I take those figures and actually show you what they lead to. But so that's some initial advice. Now, what types of investments are good for beginners? Now, if you look up investing around the internet, you're going to find that a lot of people recommend index funds. And I do too. I think investing in quote unquote an index fund of the market, which would probably be an index fund that represents the S&P 500. There's even a whole market index fund that invests in both small caps, mid caps, and large caps. You could probably find, a couple of index funds that would give you the whole U.S. market and then international exposure. But something simple like that. Index funds are great because there's no minimum investment, and nowadays you can buy fractional shares. So you can just have your $100 a month buy into an index fund ETF, which otherwise known as an exchange traded fund. It's essentially a fund that trades like a stock. And you can buy fractional shares so that your $100 can easily be invested as you save it. So I would get a brokerage account or some sort of investment account, set up an automatic withdrawal or automatic payment into that account, and then an automatic investing. Most investing platforms will do some sort of automated investing. Onto the platforms. I think most of these platforms do the same thing at this point. They give you the opportunity to buy stocks, index funds, and so on. I use Fidelity, which maybe younger people today would probably consider like, a legacy offering, or dare I even say a boomer platform. I'm a Gen Xer. But nowadays, more modern, newer platforms are things like Webull or Robinhood or whatever. At the end of the day, you're buying the same stuff through these platforms. You're buying stocks, index funds, some amount of crypto likely. All of these funds offer some access prior to at least Bitcoin and Ethereum and the bigger coins. Or at the very least, you can get into exchange-traded funds for spot Bitcoin and spot Ethereum and even soon to be spot Solana. So, pick whatever you think makes your life easier. If you're a phone-oriented person, maybe Robinhood or Webull are probably better designed for that. Though my Fidelity phone app is great. I love it. And I've just used Fidelity forever. I really think it's a fantastic platform and good company. And I love their customer service. Common mistakes for first-time investors is probably listening to influencers and doing random things, that are risky, that you don't understand, like piling all your money into some altcoin or piling all into one individual stock because some influencer says they believe that stock's going to take off. Who knows? You might get lucky with something like that and make some money, and probably that's a bad thing because then you'll double down again and probably lose it all. And that will eventually lead to you doing a more level-headed investing approach, which is probably back to the index funds, ETFs, and playing the market averages. Now, the market average historically for the S&P has been about 10% compound annual growth rate per year. That's pretty darn good. At some point in your older age, you'll want to get more out of stocks and have a more balanced portfolio. It'll produce less return, but it'll provide more capital preservation. But in your 20s and 30s, you probably just want to put your foot on the gas and go all stocks. Now, can you do better than 10%? Yes, you can. You can branch out into other assets too, like real estate. Obviously, some crypto, it's, not a bad thing. I think Bitcoin's a good bet. Other alternatives even. My only caution is if you're not going to take the effort to really learn those asset classes and understand the risk you're taking to get that better reward, and in the case of real estate, the extra work you're taking on to get that better reward, you just stick with the averages. But I think if you take my course, for example, and you do the math and you see, wow, if I increase my compound annual growth of my investments from 10 to 20%, I get to the promised land way sooner. That is motivation to seek out that better return. Just, do it with a level head and plan to do the research and get educated. If you don't have the time for that or you don't have the inclination of that, I would go with the averages play and probably do the index funds. And honestly, sometimes I wish I could go back, take many of my, efforts, investments, and experiences, wind the clock back 20 years and just put them in index funds. Probably would have done just as good, maybe even better in some cases, and had less stress. But I find it interesting and I like the learning part. And I definitely, when it comes to real estate, have outperformed, the historic S&P by leaps and bounds. There we go. I think that's enough for now for this video. I hope that was helpful, and I will see you in the next one. Thanks.